Hello guys, welcome to i-tutor Academy. In today's session, we will start with the MMBC 004 Unit 3 Financial Statements. Learning objectives of from this chapter are: after reading this chapter, you will be able to explain the meaning and objectives of financial statements of a business entity, understand the basic concept of a profit and loss account, classify income and expenses items, and understand the structure and components of a balance sheet, classify the various asset, liabilities, and capital account in a balance sheet, understand the basic principles of assets valuation, appreciate the concept of a balance sheet equation, appreciate the linkage between profit and loss account and balance sheet. And structure of this unit are: introduction is there to financial statements, objectives of financial statement, income determination, basic concept, revenue, expenses, profit and loss, income statement, preparing a trading and profit and loss account, balance sheet content and classification. Under this dual aspect concept: current asset, fixed asset, intangible asset, long term liabilities, capital or owner's equity. Relationship between income statement and position statement. Summary is there, keywords are there, and self-assessment questions and exercises are there. Introduction to financial statements. The process of accounting aims at providing the financial information about the business entity to the users with the help of financial statements. Financial statements are the formal end report that summarize the business operations and transactions conducted in a financial year. These statements are prepared as per the accounting principles to generate systematic and consistent results. They are useful indicators of the financial health of a business entity at a particular point of time. The various users of financial statements include owners and external parties such as investors, tax authorities, government, employees, etc. It is vital to present the financial statement in a proper form with suitable contents so that the shareholders and other users of financial statement can easily understand and use them in their economic decisions in meaningful way. There are three main financial statements of a business entity: the balance sheet, that is position statement, as at the end of accounting period; the statement of profit and loss, that is income statement; and the cash flow statement. Objectives of financial statement. The financial statements are prepared with the purpose of determining the financial standing of a business entity by measuring three main variables: profitability, liquidity, and solvency. Profitability is the ability of a business to make profit after paying all the business expenses out of the sales revenue for a particular accounting period. Is the entity still able to make a profit? Liquidity is the ability of a business to pay current obligation without disruption normal operations. It is the ability to pay regular bills without having to sell off assets needed to operate the business. In short, being liquid means having enough cash to pay the bills. Solvency is the ability of a business to pay all its debts if the business were liquidated or sold out. A solvent business must have more assets than it has debt. These variables are shown in the revenue generated by business, profit and loss statement, the movement of cash in a various business activities and balance cash available, cash flow statement, and the net worth of a business, that is balance sheet. Income determination, that is basic concept. To be able to understand the income statement of a business, the basic concept of revenue recognition and income measurement must be clearly understood. But before that, one must be able to distinguish between capital and revenue items. The revenue items form part of the income statement, whereas the capital item are shown in the balance sheet. These basic concepts have been discussed as below. First one is expenditure. Expenditure represent any payment or outlay made for the purpose of business. The expenditure are incurred with a view to provide benefit to the business. Such a benefit may be extended up to one accounting year or more than 1 year. If the benefit of expenditure extends up to one accounting period, it is termed as revenue expenditure. Revenue expenditure is the outflow of funds to meet the running expenses of a business, and it will benefit the business during the current period only. And also the revenue expenditure are of a recurring nature. Revenue expenditure form part of the income statement and are also referred to as expenses recognized during an accounting period. If however the benefit of certain expenditure extends for more than one accounting period, it is termed as capital expenditure. An example also there. And receipts, a similar distinction of capital and the revenue nature is made in case of receipt of a business. A receipt of a money is treated as capital receipt when the contribution is made by the owners towards the capital of the business. Example also there. And next, a receipt is considered as a revenue receipt when it is received from sales of goods or services. Received for rendering technical services or any interest or dividend earned on investments made by business, or any receipt from business activities done in the normal courses during an accounting period. Revenue receipts are shown in the income statement. They are set off against the expenses in order to ascertain the profit or loss for the accounting period. And revenue recognition. Now that we have learned about revenue receipt and expenditure, the next question that arises: when should the revenue and expenses be recognized in the book of account? So the answer lies in the fundamental accounting concept of accrual basis and the revenue realization principle. The accrual basis of accounting states that the revenue should be recorded when they are earned or accrued, and not when they are received in cash. And realization principle, on the other hand, is the point of recognizing the revenue. It states that the revenue should be recognized only to the extent to which it is certainly realizable. And measurement of income. Income is nothing but the excess of amount the business entity has earned from its operation over what they have invested into it over its lifetime. However, as per going concern concept, the business is expected to run its operation for an indefinite period of time. Therefore, it is impractical to wait till the winding up of business to measure the net income earned by it over its lifetime. There comes the concept of accounting period. And next is matching concept. The determination of profit earned or loss incurred by a business during a particular accounting period requires deduction of the expenses from the revenue relating to that period. As previously discussed, revenue is recognized when a sale is made or service is rendered, not when cash is received. Similarly, an expenses is recognized when an asset or service has been used to generate revenue, and not when the cash is paid. It is worth nothing. That's only when a cost is recognized or accrues during the accounting period it become an expenses. And for example also there quoted, and you just go through your material. Okay, so this is about today's session. Next section of revenue and expenses we will discuss on next video. If you have any doubts on this, you can contact our contact number. Also, you can comment it on our comment box also. Thank you so much.
i-tutor ES presents IGNOU MBA, complete syllabus coverage classes and individual semester base, subject coverage program for MBA students online and flexible sessions. For more details, contact 62382 17885.